Hi all. So today we'll be covering study unit 3, which focuses on your capital allowances and recoupments. And after the study unit, you will be familiar with what are capital allowances or allowances of a capital nature that are permitted and the calculations thereof, allowances applicable to the process of manufacturing, and the calculation of allowances that are based on various dates. So yeah, let's get into it. So again, these are some previous notes on capital allowances which you have to go through and which you have to understand. And you also need to go through chapter 13 in the 2018 Silk South African Income Tax book, which is capital allowances and recoupments. Please work through that chapter with all the examples and all the work on there, but particularly focus on the section 12C or section 12. So in particular focus on your manufacturing equipment and your allowances for movable assets, as well as so your allowances for movable assets, so that's your normal wear and tear allowances, but also your allowances used in manufacturing equipment, and also the allowances for small business corporations. Okay, and then allowances of immovable assets, which is buildings. So there you need to know section 13 of the Income Tax Act. And then recoupments. What are recoupments and how is it dealt with in the Tax Act? And assets which are leased, how is that dealt with? So please work through your capital allowances and recoupments chapter in the Silk South African Income Tax book, as well as your study unit. Okay, so let's get into it. So capital allowances. So remember from your general deduction formula, there are specific expenditures which are excluded from that formula, as they are more of a capital nature, and that is where the concept of a capital allowance comes in. So the Act allows for these assets which were initially excluded from the general deduction formula to now have a specific capital allowance which you may deduct from your taxable income. And a capital allowance is basically a write-off of the cost of an asset over a period of time. So that's essentially a capital allowance. If you think about capital allowance, think more in the line of depreciation, but it does go more broader. It is a bit more broader than depreciation, but generally think about it in that sense. Okay, but capital allowance is just a write-off of the cost of an asset over a period of time. And very importantly is your costs. Your cost includes anything to get the asset ready to start in the manufacturing, or to any moving costs, installation costs, or costs relating to getting an asset ready for use. But very importantly, these costs, it has to exclude VAT, because VAT is dealt with separately in the Tax Act. Okay, so there are certain capital allowances from the Tax Act which are important and which I'll be going through in detail now, starting with your repairs and maintenance. So certain expenditure on repairs incurred by an entity or business or even an individual may be deductible, but it has to be in respect of the property occupied for trade or income generation. So in other words, it has to be in respect of the building which you use for your trade purposes. So it can't be your personal home, it has to be, you need to generate income from this property, or it has to be where you have your trade, this building has to be used for trade purposes. Okay, and these repairs can be for treatment against pests, but it can also be for repairs and maintenance on machinery, implements, and utensils. So again, this has to be for the purposes of trade or income generation. So any improvements or additions are not deductible as it is of a capital nature. Okay, so repairs, those are deductible if it relates to trade or income generation, but any improvements or additions, that is not deductible because that's more something of a capital nature. So you have to distinguish between what is a repair and what is an improvement. So improvements generally are the creation of a better asset, while repairs is the restoration by a renewal or replacement. So in repairs, the cost of the repair is deductible even if you are not the owner of the property of the asset. So importantly, you have to use this asset or property in the for the purposes of trade or to derive an income thereof. Okay, so basically what section 11D says that repairs of any property or machinery, implements, or utensils which is used for trade or income generation, the cost for these repairs are an allowable deduction. But improvements or additions, that is not a deduction as it is of a capital nature. Okay, so that's fairly simple. So the next one is your wear and tear, which is section 11E. So section 11E, this is one you will always get in a question, and it is fairly simple. So the way to think of your section 11E wear and tear is you need to think about it as depreciation. So in accounting, when you do depreciation, you take your asset and you depreciate it according to, well, for example, the straight line method over a number of years. And that's exactly what you do with your wear and tear. With the wear and tear, you've got practice note number 47, which provides some acceptable write-off periods for any type of asset. So it will tell you, for example, that a delivery vehicle, the write-off period for delivery vehicle is 4 years. So that means when you have your delivery vehicle, that means you need to take the cost of your delivery vehicle, and the wear and tear, section 11E allowance on this delivery vehicle will then be the cost divided by 4 years, and that's then the allowance each year, the wear and tear allowance. Okay, so yeah, with this practice note 47, you can easily find that on the SARS website, but in a test you will they will tell you what the acceptable write-off period is for this asset. So you don't need to study this, but you just need to be able to apply it. Okay, so your wear and tear allowance, so it allows the deduction of a value of an asset, which we have discussed. It's very similar to depreciation. But very importantly is this asset, it has to be owned, acquired, or used for the purposes of trade by the taxpayer. Again, it can't be for personal use. So the vehicle which is used, your Sunday vehicle, your convertible car which you use just to drive on Sundays, show off, that is not used for trade. That is used just for you to brag or to show off. But your delivery vehicle, which you use in delivering your goods to your clients, that is used for your trade, and on that you may deduct a section 11E wear and tear allowance. Okay. And also very importantly is you need to apportion the wear and tear allowance according to the part of the year where it was earned. So for example, if you bought a vehicle 1 month before the tax year end, then that means that you owned that vehicle for 1 month during the current year of assessment. So that means that you need to take the cost. So let's say for this example, it is 100,000 Rand for this vehicle. You need to divide it by 4 years, because according to practice note 47 or interpretation note 47, that is the allowable deduction for a delivery vehicle. I think it's 4 years. So it's 100,000 divided by 4 years is 25,000 Rand. But then you need to multiply it by 1 out of 12 months, because you only had it for 1 out of 12 months for the current year of assessment. So that means that your wear and tear allowance during the current year of assessment will then be 2,083.33 cents. Okay, so importantly is the wear and tear, you need to apportion it according to the year, according to the period of the year which you owned this asset. And then any items which is less than 7,000 Rand, you may write it off in full during the current year of assessment. Okay. So that's, for example, a computer. When you buy a computer for 6,000 Rand, that full 6,000 Rand you can write off during the first year of assessment, because it's less than 7,000 Rand. Okay, so let's have a look at a quick example. So we've got Muchi Pty Limited. They acquired a motorcycle at a cost of 40,000 Rand. And importantly, this cost excludes VAT. So that's another thing to note, or to take note of, is any cost of these assets, you need to exclude VAT on that, because VAT is dealt with separately in the VAT Act. So we acquired this motorcycle for 40,000 Rand on the 1st of March 2018 and immediately brought it into use in its business for the purpose of making deliveries. Okay. It used the motorcycle for the rest of the year of assessment ending 31 August 2018 and through its year of assessment ending 31 August 2019. So what we want to do is we want to calculate the wear and tear allowance to be claimed in the 2018 and 2019 year of assessments. So then they give you some additional information and tells you that the taxpayer elects the straight line method. So binding general ruling from the income tax, number 7, and interpretation note 47. It allows for a write-off period on a motorcycle of 4 years. Sorry, forgot to add that. Okay, so let's have a look at the solution. So during the 2018 year of assessment, so we bought this vehicle for motorcycle for 40,000 Rand. The interpretation note 47 tells you that a delivery vehicle, the wear and tear allowance on that is 4 years. So we're going to say 40,000 Rand, divide by 4. And now we only had it for 6 out of 12 months, because we had it from the 1st of March 2018 until the end of the year of assessment, which ended 31 August 2018. So that is 6 months. Okay, so we need to multiply it by 6 over 12 months. So during the first year of assessment, you may allow a 5,000 Rand wear and tear section 11E deduction, capital allowance deduction. Okay. Okay, and then during the 2019 year of assessment, we had this motorcycle for the full year of assessment. So we're going to say 40,000 Rand, the cost of the motorcycle, divide by 4 years, because that's according to the interpretation note 47, the allowable write-off period for delivery vehicle. And that gives you then a wear and tear allowance of 10,000 Rand during the 2019 year of assessment. Okay, so it's fairly simple. You just need to take into account what they give you as the write-off period, and you also need to portion it for the portion of the year in which you own this asset. So some things to remember in terms of section 11E allowance is this can be claimed on only on assets that do not qualify for other allowances. So if this asset qualifies for a different allowance, then you may not claim this wear and tear allowance. So that's more your manufacturing assets. Those qualify for a Section 12 allowance. So therefore, you can't claim a double allowance on that. Okay. And this allowance, you may never claim it on buildings. So buildings again also has a different allowance, a different allowance. That's Section 13 of the Tax Act. Okay, and then also you need to apportion this wear and tear allowance has to be apportioned for the period it was used in a taxpayer's trade. So yeah, the taxpayer doesn't specifically prescribe the method of apportionment, so you can either use the number of days or the number of months used in a taxpayer's trade during the year of assessment. But any example, you will most likely get something simple where it's the number of months, so 6 out of 12 months or whatever. Okay, so now what you want to do is you want to now calculate whether if you sell an asset, whether you made a recoupment or a gain, or whether you made a loss on a disposal of any fixed asset. So we're going to deal with a loss on a disposal of fixed asset first. So that's Section 11O. So your Section 11O allowance. So it is an elective provision only in respect of an asset on which initially you have claimed a capital allowance and where the useful life does not exceed 10 years. So in other words, buildings, you won't be able to claim a Section 11O allowance because the useful life on that is it's much more than 10 years. And also where the disposal arose as a result of a sale, scrapping, loss, or destruction. Okay, so when these conditions are met, then you may calculate whether you made a loss or recoupment on the disposal of a fixed asset. So in calculating your Section 11O allowance, you need to take the cost of the asset which you initially bought it for. Then you need to subtract the aggregate amount of any allowances or deductions allowed. So in total, all the allowances which you wrote off in the previous years of assessments, you need to subtract all of those allowances together, and then also what the proceeds was on this disposal. So how much you sold this asset for, or if this asset got destroyed, then what was the insurance proceeds that you got? So you need to subtract that, and that will then give you a Section 11O allowance. So if there's a loss. Okay. So you just need to go through that, and we're going to go through some examples a bit later. Okay, and then what you also get is your Section 12 allowances. So Section 12 allowances are allowances on manufacturing assets or processing assets. So your Section 12B allowance is mostly allowances for manufacturing businesses, and these are on some examples on these manufacturing assets are, for example, farming plant and equipment. So that's these equipment owned by the farmer, and it has to be for income generation. Assets used in the production of biodiesel or bioethanol, assets used in a trade to generate electricity through wind, sunlight forces of not more than 30 megabytes or biomass comprising organic waste, landfill gas, or plants. So these are just some examples, but there's a whole list of examples, and you can actually find the Tax Act actually specifically mentioning what are manufacturing assets and what are not manufacturing assets. So you can go on the website and look for that. But for now, all you need to know is these are assets which are used in manufacturing businesses, and it has to be assets which the manufacturing business owns. And on this, you may claim a Section 12B allowance. And this Section 12B allowance is based on the cost of the asset. In the first year of assessment, you are allowed to, I need to just track back. I spoke a bit wrong. And that is, these are all your assets which are non-manufacturing assets. So if it's a non-manufacturing asset, so your normal equipment, these examples which I mentioned here, and if it's for a small business entity, then you may deduct a allowance of 50% of the cost in the first year of assessment, 30% in the second year of assessment, and then 20% in the third year of assessment. And then thereafter the asset is completely written off. Okay. So for a small business corporation, if it has a non-manufacturing assets, so these are the assets which are mentioned here, and you can also find a whole list on the SARS website or in your textbook, then the allowance will then be 50% of the cost in the first year, 30% of the cost in the second year, and 20% of the cost in the third year. Very importantly is this cost should not be apportioned for the part of the year. So you take, even if you had this asset for one day during the current year of assessment, you can subtract 50% of that during the current year of assessment. So you don't need to apportion it for 1 month or 2 months or whatever portion of the year that you had it. Okay, so that's your Section 12B allowance. Okay, and your Section 12C allowance. So Section 12C allowance is your unmovable assets used by manufacturers. So this is on manufacturing businesses for research and development, or by hotel keepers and ships, aircraft, and assets used for storage of packing of agricultural products. So important with this is your Section 12C is on manufacturing businesses, whereas your Section 12B is more for small business corporations, and that's your non-manufacturing assets. So your Section 12C allowance, it allows a special wear and tear granted in respect of machinery and plant used in the process of manufacturing, assets used by a hotel keeper, assets by an agricultural cooperative for storing or packing farm products, aircraft or ships bought after the 1st of April 1995 for purpose of trade, and also where the assets are leased Okay, so those are the manufacturing. So what you need to know about 12C is it is on manufacturing businesses, and if you lease an asset, this manufacturing asset, then you may claim the allowance, a Section 12C allowance, if you are the lessor, so if you are the person leasing this. So you may claim it if you lease an asset. And then the right of period is either 4 or 5 years, depending on the nature of the asset. So if it's a new asset, then you will allow, then the Section 12C allows for a write-off of 40% during the first year of assessment, and then 20% for the remaining, or for the next 3 years of assessments of the costs. So new manufacturing asset, you've got 40% of the cost in the first year of assessment, and then 20% of the each remaining years. So for year 2, 3, and 4. If this asset is used, if it's a used asset, then a write-off will then simply be 20% of the cost over a 5-year period. Okay. And then also what you get is environmental expenditure allowance, so that's section 37B. So that's just an allowance of if you in a treatment of the environmental treatment. So in other words, this is especially important for mines where they need to ensure that the land is exactly as it was before they started their mining operations, and also recycling assets. But you just need to take note of that. I don't think it's important for a test or so. Okay, but what you need to know is you've got your section 12B allowance, which is for small business corporations, non-manufacturing assets, and on that you may deduct a 50% of the cost in the first year of assessment, and 30% on the second year, and 20% in the third year of assessment. But for a section 12C allowance, this is more for your manufacturing businesses. On that, any new manufacturing assets, you may deduct a 40% allowance during the first year of assessment and a 20% for the remaining 3 years of assessment. But if it's a used manufacturing asset which you acquire, then it will be a 20% allowance of the cost for over a 5-year period. And again, this you don't need to, or this you should not apportion it for the portion of the year. It should be the full 20% or 40%, even if you only have the asset for 1 month or whatever. Okay, so building allowance, your section 13. So in an industrial building, section 13.1, it allows an annual allowance of 5% of the cost of the industrial building. So it's basically based on the cost of a building used wholly or mainly in the purpose of manufacturing. So if this industrial building is not used for manufacturing, then you may not claim this allowance. It has to be wholly or mainly used in the process of manufacturing. And then the cost of any improvements can also be deducted in terms of this allowance. But importantly is that this allowance should not be apportioned if the building is only used for part of the year. So again, it is only a 5% allowance. And you need to claim on the cost of a building to the purchaser and not the original cost. Okay, but also very importantly is land has to be excluded. So it should be on the actual building itself, not the land. And the section 13 allowance then is just 5% of the cost. And there are some other instances which you can find in your book, but generally it will only be the 5%. These instances where it's different is when it is on when the industrial building was built initially. So there's some certain different rates, which allowances. So you need to have a look in your SELF book on that. But generally, you will almost always get only the 5%. Okay. And then that was on industrial building, but you also have residential buildings. So that's section 13 TUR. So this was introduced in the Tax Act to encourage the construction of residential housing units which consist of at least 5 residential units. You can have a look at what is a residential unit. It's just a self-contained residential accommodation consisting of more than one room, which is erected in order to be let to a tenant for the purpose of deriving a profit, or occupied bona fide full-time employee of a taxpayer. So the allowance on this is then 10% of the initial cost in the first year of assessment, and then a 2% annual allowance calculated on the cost. So in the first year of assessment, basically have 12% allowance. But importantly is this only applies to residential housing projects on or after the 1st of April 1982 and before 21 October 2008, because these are then replaced by Section 13(6) and Section 13(7). So Section 13(6) claims that, or in Section 13(6), you may claim an allowance of 5% on the cost if a building was erected on or after the 21st of October 2008. And then a Section 13(7) allows for a deduction of 10% of the outstanding loan amount at the year end. But yeah, you just need to remember that any buildings which was built before, any residential buildings which was built before the 21st of October 2008, there's a 10% initial allowance on the cost and a 2% annual allowance on the cost for each year afterwards. But if a residential building was erected after the 21st of October 2008, then it is replaced by Section 13 SEX, and that states that you may claim an allowance of 5% on the building. Okay, and then what you also get is your urban development zone allowance. So that's Section 13 Quant. So this is again was introduced to encourage the development of in specific areas, and the allowance was granted for the refurbishment of buildings. So it's a 20% straight line depreciation, or the construction of new buildings. So it's a 20% write-off of the cost in the year 1 and 8% write-off of the cost in the following 10 years. So yeah, the government went and introduced certain development or specific areas to encourage development, and if it was in the specific area, then you can claim a Section 13 Quat allowance. And then if it was only for a refurbishment of an old building, then you may claim a 20% allowance for over a 5-year period. But if you constructed a new building, then you have a 20% write-off of the cost in the first year and an 8% write-off of the cost over the following 10 years. Okay, and then when the owner disposes of a building or no longer uses it for trade, he will recoup the allowance he claimed on. So the buildings, yeah, so this is buildings purchased by the taxpayer after the 8th of November 2008. In a test, they will tell you that this building erected was for in an urban development zone, specifically required, so then you need to know it's a Section 13 Quat allowance. Okay, and then trading stock, this is just something which we'll deal with on a later stage, so I'm just going to go through that quickly. So trading stock is basically anything which you trade to make a profit on. So it's anything which you produce, manufacture, construct, assemble, purchase, or in any other manner for the purpose of manufacture, sale, or exchange by the taxpayer. And then this process has to form part of your gross income, or it is any consumable stores or spare parts acquired by the taxpayer to be used or consumed in the course of this trade. So yeah, trading stock, you just need to think about inventory. It's the same as inventory. The trading stock includes anything held with the intention to dispose of at a profit, and the purchase of trading stock is deductible, being an expense incurred in the production of income and not of a capital nature. So Section 22 provides that the opening stock must be deducted from income, and a closing stock must be added to income in the determination of taxable income. So yeah, if you get a question with any trading stock, then what you need to do, according to Section 22, the opening stock has to be deducted from your income, whereas the closing stock has to be added back to your income in determining your taxable income. Okay, and then just some other donations. You've got a donation to public benefit organizations. That's your section 18A. So that's when you make a donation to any donation to any charity or any public benefit organization, then the portion of this donation may be deductible according to section 18A. But very importantly is you have to have a section 18A receipt, a valid receipt from this public benefit organization in order for it to qualify as a deduction. So the deduction is also limited to 10% of the taxpayer's taxable income after deduction of the allowable contributions, but before the medical expenses of these donations. But donations we're actually going to do on a later stage. You don't need to worry about it now. Okay, and then just quickly a few prohibited deductions according to section 23. You've got private and domestic expenditure. So it prohibits the deduction of any private or domestic expenditure, which is section 23A and B. The losses or expenses recovered under a contract of insurance, guarantee, security, or indemnity. So any insurance payout which you receive, that is a prohibited deduction. You may not deduct that. Taxes, penalty, and interest on tax. So if you got any penalties on your tax for late payment or late submission, that is not an allowable deduction. Provisions, you may not claim provisions for future expenses, expenses to produce exempt income, restraint of trade payments, expenditure relating to employment, fines and unlawful activities, and expenditure incurred in the production of foreign dividends. Okay, so these are just a list, but what you need to know is your section 11E, your wear and tear capital allowance, and then your section 12B and C, as well as section 13 allowances. Okay, those are the most important ones. But now let's have a quick look at your study guide and what you need to learn from, or what you need to know from there. Okay, so again, after this study unit 3, what you need to be able to know and understand is what allowances are of a capital nature, but which the Tax Act specifically allows some allowances, deductible allowances, and the calculation thereof, and the allowances applicable to a process of manufacturing, as well as the calculation of the allowances that are based on various dates, that's your wear and tear allowances. Okay, so expenditure of a capital nature is not deductible according to section 11A. But however, the Income Act specifically provides some specific provisions to deduct the cost of fixed assets over a period of time. So take note, it's the cost of the fixed asset. So with a capital allowance, you need to think of it as depreciation, or the loss of value of an asset. So any cost incurred relating to asset can be divided into either cost incurred or leased of an asset. So there are some specific rules depending on the type of the cost. So for example, whether it's the lease payments or the improvements, and a tax implication dependent on the type of cost and status and nature of the ownership. Or it can be the cost incurred to assets owned. So just either you lease this asset or you own this asset. Okay. So looking at the tax implications of assets owned by a taxpayer, there are basically two important things that you need to know, two important implications. So for a small business corporation, you may So yeah, movable assets are divided into basically small business corporations or manufacturing businesses. So when it's a small business corporation, then if a small business corporation has a manufacturing asset, then you may deduct the full 100% of this manufacturing asset in the first year of assessment. But if this asset is a non-manufacturing asset for a small business corporation, then you may deduct 50% of the cost in the first year of assessment, 30% in the second year, and 30% in the third year of assessment. Okay. But if it's a manufacturing business, then for manufacturing assets, any new manufacturing asset, you will allow a deduction of 40% in the first year, 20% in each of the remaining 3 years. But if it's an old or used asset, then it's only a 20% deduction over a 5-year period. And then any other assets for a manufacturing corporation will allow a Section 11E wear and tear allowance, but we'll discuss all of this a bit later. Okay, and any other asset is then a Section 11E time-based allowance, so wear and tear allowance. So you just need to distinguish whether it is a manufacturing asset or non-manufacturing asset, and whether it's for a small business corporation or manufacturing business. So either one or either way, they will tell you in the test whether it's a small business corporation or manufacturing business, but you need to know all the rules relating to all of these assets. Okay, just some key terminology. So capital allowance, what is it? It's a write-off of the cost of an asset over a period of years. And this cost of asset includes all the costs to get this asset ready for use, and all delivery, moving costs, installation costs, or erection costs in getting this asset ready. But importantly is that this cost needs to exclude VAT, as it is claimable as an input tax and also finance charges. Finance charges and VAT you may not include in the cost of a manufacturing asset, because you already deal with it when you calculate your input VAT. Okay, and then any depreciable asset is subject to a capital allowance. So what is the tax value? The tax value is basically the cost of this depreciable asset less the aggregate capital allowance already claimed. So it's the cost less the allowance claimed. Okay, and then when you calculate your tax value, then you can you dispose of this asset, then you can either make a loss on the sale of an asset, and there you will make a scrapping allowance, or you can make a recoupment, a gain on the sale of an asset. So both of these are dealt separately, and we're going to have a look at them now. So depreciable assets for trade purposes, either sold, damaged, or which are economically useless, you may claim certain allowance on this. So if you make a recoupment, so in other words, when your tax value, or when you make a gain in the sale or disposal of an asset, then you qualify for Section 84E recoupment allowance. So this is a special concession when a manufacturing machine is replaced by another, either by a new or used asset. Now, this recoupment will not be included in the full year it is sold, but it's spread over a period of time over which the capital allowance or replacement asset will be claimed. So that's the taxation payable on recoupment is effectively postponed to the future tax periods. So having a look at a quick example. So we've got company C purchased a new machine A from a VAT vendor for 650,000 Rand, and this excludes VAT on the 1st of May 2014 and brought it into use on the same date. This machine was destroyed in a fire on the 1st of January 2015, and Company C received an insurance payout of 480,000 Rand from the insurance company on the 1st of February 2015. So we bought an asset for 650,000 Rand, and importantly, it excludes VAT. So we already claimed the input VAT on that. And then this machine got destroyed by fire. And we got a 480,000 Rand payout, insurance payout from this on the 1st of February 2015. So machine A was replaced by machine B. Machine B was purchased second-hand on the 1st of February 2015 for 850,000 Rand, again excluding VAT, and brought into use on the same day. So what do we want to do is we want to calculate the recoupment amount that will be included in Company C's taxable income for the year of assessment ending 31 March 2015. So if Company C elected that paragraph 65 and 66, so Company C elected that paragraph 65 and 66 of the 8th schedule should apply. So that relates to your recoupments. Okay, so let's have a look. So what is the cost price? The cost price is 650,000 Rand less VAT, or excluding VAT. It needs to exclude VAT. And then on this asset, because it was a new asset, it qualifies for Section 12C allowance. So we'll deal with this a bit later. But basically, when you've got a manufacturing asset and if it's a new and it was bought new, then you may claim 40% of the cost in the first year of assessment. So if we take the cost less the Section 12C allowance of 260,000 Rand, then the tax value at the end of the year of assessment will then is then calculated as 390,000 Rand. But then this asset got destroyed and we received a payment of 480,000 Rand. So we take this 480,000 Rand less the tax value of when it was destroyed. So what did we make? We made a gain on this destroyed asset of 90,000 Rand. Okay, so we made a recoupment of 90,000 Rand. But also paragraph 65, which we'll also deal with a bit later at a later stage, that states that on this recoupment you may or you qualify for 20% allowance, taxable recoupment during the current year of assessment, and that you may then spread over the remaining a remaining 5-year period. So in other words, in a 2015 year of assessment, we qualify, or this company qualifies for taxable recoupment of 18,000 Rand. Okay. And then we purchased machine B for 850,000 Rand, excluding VAT. Again, that's very important. So this also qualifies for Section 12C allowance because it's a manufacturing asset, but it was a used machine which we bought. It wasn't a new machine, so that's why it only qualifies for 20% allowance in the first year of assessment. So in other words, the Section 12C allowance for machine B is then 170,000 Rand, which we may deduct from our when we calculate our taxable income. Okay, so just importantly, according to paragraph 65, you can see that the 90,000 Rand recoupment or gain which we made, that you can spread, that is spread over a period of 5 years. So in other words, you only have an 18% recoupment during the 2015 year of assessment, okay, which you may claim. Okay, so basically what we just did is any new or unused plant and machinery acquired by or improved in the use of manufacturing, you may claim an allowance on that. So if a taxpayer owns the asset or acquires it in terms of an installment agreement, then the cost to be written off according to Section 12C is 40% in the first year of assessment in which it was brought into use, and then 20% in each of the following 3 years until it's fully written off. So that's importantly, this allowance, this 12C allowance, is for a manufacturing business in when they acquire a new asset or manufacturing asset. Okay. And then if you dispose of an asset, or if an asset is damaged beyond repair, then you need to either calculate a recoupment or scrapping allowance. A recoupment is what we just did, is when you make a gain. So if your proceeds is more than a tax value, remember your tax value is your cost less your allowances, your capital allowances. So then you make a section 8 for a recoupment. But if your proceeds is less than your tax value, then you have a scrapping allowance. So that's section 11.0. So again, yeah, it's basically just the opposite of what we just did in this recoupment. So this just again tells you what is your tax value is, the cost on which the capital allowance was granted, less the capital allowance previously granted on the asset. So the cost less the capital allowances. Okay. So what is the process of manufacturing? The Income Act defines a process of manufacturing as when you have your end products has to be essentially different from what it was before. So in other words, it has to undergo a process, a continuous process in basically changing your products. And the process a process of manufacturing can also be when so in a process of manufacturing, you need not have to produce the end products, but as long as you contribute towards it. And also this process of manufacturing, it has to be held. This process. Okay, so yeah, you can just have a look at practice note 42, which just lists some processes accepted by SARS as being manufacturing processes, but essentially what you need to know, and it's common knowledge, you've got your end product should be different from what it was before, or in the process manufacturing, it has to, in producing your end product, it has to contribute towards it, and it has to be on a large scale. You can't produce something 5 products over the course of a year, 5 small products. Okay, but yeah, you just need to use common sense. But you can have a look at practice note 42 on a list of all processes accepted by SARS as being manufacturing processes. Okay. So what we did up until now was a section 12C allowance, but now you also get a section 12E allowance. Now section 12E allowance is specifically for small business corporations. So for manufacturing plant and machinery, the cost of any new or unused manufacturing machinery brought into use after the 1st of April 2001 for the purpose of trade may be claimed in full in the year of assessment in which it was brought into use. But importantly is that the allowance claimed on the cost has to be the lesser between the actual cost or the market value on the date of acquisition. Okay, so what this basically tells you that is that for a small business corporation, to qualify for section 12E allowance, it has to be a small business corporation, and for a manufacturing asset, you may claim the full cost of this manufacturing asset in the first year of assessment. And the cost has to be the lesser between the actual cost or the market value on the date of acquisition. So that's for manufacturing assets for a small business corporation. But any other asset, what you need to do is you can either, the taxpayer of a small business corporation can either decide to deduct a section 11E wear and tear allowance, so that's a time-based allowance by SARS. We'll deal with that now, and we have dealt with it before, so that's your normal wear and tear allowance, or it may deduct it as a 50-30-20 allowance. So 50% in the first year of assessment, 30% in the second year, and 20% in the third year of allowance. So again, for any other asset, apart from manufacturing assets, the taxpayer may specifically or may decide how they want to claim this capital allowance. It can either be in terms of section 11E, a time base as allowed by SARS and interpretation note 47, or 50-30-20, 50% in the first year of assessment, 30% in the second, and 20% in the third. Okay, and you need to calculate it for the full year of period it was used during the year of assessment. So if we look at our example, we've got Shaggy Limited, a small business corporation. So here they tell you it's a small business corporation, so immediately you need to know it's a section 12E. It is a manufacturer of school shoes. So manufacturer, that's again also important. So if it's a manufacturing asset, then a small business corporation, they may claim the full 100% allowance. On the 6th of April 2016, the corporation purchased a new manufacturing machine to the value of 150,000 Rand, excluding VAT, and it was brought into use on the same date. Due to the expansion of the business, the corporation also purchased 4 new computers during September 2016 for the use of administrative staff. The total cost of the 4 computers was 65,000 Rand, excluding VAT. The computers were brought into use on the 1st of October 2016. Okay, so we've got 2 things. We've got a manufacturing machine of 150,000 Rand and then 4 computers to the total of 65,000 Rand. And importantly, both these values excludes VAT. So we already claimed the input VAT on them. So what are you required to do is you need to calculate the capital allowances for the taxpayer to claim in the 2017 year of assessment. Okay. So what do we have? We've got a manufacturing machine. The cost was 150,000 Rand, excluding VAT. So because it's a small business corporation, the allowance on this is 100% in the first year of assessment, in the year of assessment in which this manufacturing asset was acquired. So we may claim the full 150,000 Rand. And then the 4 computers, the 4 small business corporation, or other assets, the taxpayer may elect how they want to write this off or claim this allowance. So in this case, the method which was to the largest advantage of this taxpayer was to claim the 50-30-20. So on these computers, we're going to claim 50% of it in the first year of assessment. So in other words, the allowance is then 32,500. Okay. Okay, and section 12C is for assets in the process of manufacturing. So section 12C states that again, you've got a certain allowance on new or unused assets. So any new or unused plant or machinery acquired or improved by the taxpayer brought into use for manufacturing or similar process, you may claim an allowance of 40% in the year of assessment in which it was brought into use, or 20% in each of the following years. So that is for a new asset. Okay. But this cost, it needs to include all moving, all costs in order to get this asset ready, or all moving costs that needs to form part of the cost. The removal costs are written off over the remaining useful life if incurred after the asset was brought into use. So we'll do an example on that now. And again, it's calculated for the full year of period it was used during the year of assessment. So you do not, for manufacturing asset, you do not proportion it according to the portion of the year. You use the full year of assessment. But if this manufacturing is brought into use as second-hand or used, then the allowance is simply at 20% per year over a 5-year period. Okay. Okay, so up until now we've done your manufacturing assets, but you also get a wear and tear allowance. So that's section 11E. So any assets which does not qualify for section 12C or 12E allowance may qualify for a wear and tear allowance. So importantly, for this asset to qualify for a section 11E allowance, the asset must be owned or purchased in terms of an installment agreement or used for the purposes of trade. And the allowance is also very importantly calculated on a pro rata for the period the asset was in use during the year of assessment. So SARS in interpretation note 47 has a whole list of acceptable write-off periods on any type of asset which you can find. So for example, on furniture and fittings, SARS allows a 6-year write-off period. On computers, it allows a 5-year write-off period. So in a test, they will tell you what the write-off period is. You don't have to study this list, but you just need to know that there is a list of all the allowable write-off periods according to SARS. Okay. Okay, looking at an example, we've got company X, which is a registered VAT vendor, bought one mainframe computer on the 1st of August 2014 for 114,000 Rand, VAT inclusive. Remember what we said? In calculating any capital allowance or any allowance, it has to be excluding VAT. So because they tell you that this amount is VAT inclusive, we need to take out the VAT amount on this. Okay. So the company has a March year end, and according to interpretation note 7, it allows for a 5-year write-off period in respect of these computers. The company also incurred 9,000 Rand for the installation of the computer. Okay, and then on the 1st of June 2015, Company X moved the mainframe computer to its new offices and incurred a moving cost of 11,000 Rand for this moving cost. So what are you required to do? You are required to calculate the wear and tear allowance on the mainframe computers for the 2015 and 2016 years of. Okay, so if we look at the 2015 year of assessment ending on the 31st of March, we got this mainframe computer which we bought for 140,000 Rand, VAT inclusive. So we first need to take out the VAT amount. So we're going to say multiply by 100, divide by 140, gives you then 100,000 Rand cost of this VAT, of this mainframe of the computer. But included in the cost is any cost, any installation, moving cost, or cost to get this asset ready for use. So we had an installation cost of 9,000 Rand. So in other words, the cost of this mainframe computer is then 109,000 Rand. On this mainframe computer, it qualifies for a Section 11E allowance over a 5-year write-off period. So we're going to take this 109,000 Rand and we're going to divide it by 5 years. And then we're going to multiply it by the portion of the year in which we held it. So this mainframe computer we bought on the 1st of August 2014, and we held it until in the 2015 year of assessment until the 31st of March 2015. So we held it for 8 out of 12 months. But in other words, the Section 11E allowance, which this mainframe computer qualifies for is 14,533 Rand. Okay, and then looking at the 2016 year of assessment, what do we have? We've got the mainframe computer of 109,000 Rand. So it's the cost of this computer. Divide by 5-year write-off period. So in other words, the Section 11E allowance will then be 21,800. Okay, and then also on the moving costs, which was incurred on the 1st of June 2015 for the mainframe computer, we can claim a Section 11E allowance on that. So the moving cost was 11,000 Rand, but during the current year of assessment, so from the 1st of June 2016 until the 31st of March 2016, there is 10 months. But the remainder time of this capital allowance in which you can write it off is then 50 months. So that's basically from the 1st of June 2015 up until the 31st of July 2019, because we bought it on the 1st of August. So that's a 5-year period. So in other words, there's 50 months remaining on this. So that's why we're going to take this allowance and for this moving cost, and we're going to multiply it by 10 months for a current year, divide by 50, which is the remainder time. So that then gives you a Section 11E allowance on the moving cost of 2,200 Rand. Okay, so just go through that question in your study guide again to understand that. Okay, and finally what we have is lease assets. So in lease assets, in rent paid, that's Section 11A, the rent paid on a lease asset is deductible provided that all requirements from a section is met. So it's only deductible from the date on which the lease asset is brought into use for tax purposes. Okay, so if you pay rent on a lease asset, then that is deductible. And your lease premiums, the lease premiums is also deductible in terms of Section 11F. So there's a specific provision for the initial lump sum on the signature of a contract, which is deductible, and it states that the lease premiums or similar considerations are deductible if it's paid by the taxpayer for the right of use or occupation of land, building, plant, or machinery, and used or occupied for the production of income. So then the deduction for each year of assessment will then be divided by the total lease premiums by the number of years entitled to or use, but this is limited to 25 years. So again, you just need to go through that that section. Okay, so that's in a nutshell your capital allowances and recoupments study unit 3, but it is much broader than what I just went through now, and the onus is on you to go through the capital allowance and recoupment chapter 13 in the 2018 SILP textbook, or if you have a previous year, just look for the capital allowance and recoupment chapter, and to understand all the sections within that chapter. Okay, these are just the most important sections, but there might be some other stuff which you might also need to know and understand. Okay. Okay, let's look at a quick question. So we're going to go through question 8.1 in the graded questions on income tax in South Africa textbook 2018 edition, which you all should have. And yeah, so let's have a quick look at that. So we've got the following information relating to the purchase, sale and replacement by Spades Limited of certain plant and machinery used by it directly in its manufacturing process. So we've got the original plant, which was purchased on the 1st of February 2016. When we purchased it, the condition was used. So already that needs to tell you that yes, this is a manufacturing process. So in other words, if it's used, then the capital allowance will be 20% over a 5-year period. The cost of this plant was 8,400 Rand. It was paid for in cash and was brought into use on the 1st of February 2016. And then we sold it on the 31st of July 2017. Why did we sell it? Because it was damaged due to a flood, and the date of the flood was the 1st of July 2017. So the amount we obtained from this sale was 8,000 Rand, and that was from an insurance payout. Okay, so that's the old machine. We bought it for 8,400 Rand on the 1st of February. We had to dispose of it on the 31st of July because it got damaged. And from this disposal, we got an 8,000 Rand insurance payout. So we need to do two things. We need to either calculate whether we made a recoupment or a scrapping allowance, and we also need to calculate the capital allowance, allowable capital allowance on this asset. Okay, so that's the original plant, but we also replaced this plant on the 30th of November 2017 by an unused, so in other words, a new manufacturing process at a cost of 16,400. It was brought into use on the 31st of January 2018. So then they also give you some other information, being that Spades Limited factory premises are in the Durban area. The flood damage rendered its original plant unusable with immediate effect. It intends to take advantage of the provision of Section 84E of the Income Tax Act, if applicable, and its plant and machinery qualifies for the Section 12C capital allowance. And what are you required to do? You are required to set out the new capital allowance available to Spades Limited in the determination of its taxable income for each of its years of assessment ending on the last day of February in 2016, 17, and 18. Okay, so let's have a look at the solution. So we've got this asset which we bought on the 1st of February 2016. So in other words, that is in the 2016 year of assessment ending end of February 2016. So because it is a manufacturing process, then that means that this asset will then qualify for a Section 12C capital allowance. Now what is a Section 12C capital allowance? It's on a used plant. So in other words, the allowance will then be 20% on the cost over a 5-year period because it's second hand. Okay, so the original cost was 8,400 Rand multiplied by 20%. So the Section 12C capital allowance for the first year of assessment is then 1,680. On any manufacturing asset, we do not apportion it for the portion of the year. We use the 20% for any portion of the year. So even if we owned this asset for only a month. Okay, so that's in the 2016 year of assessment. Then we had a 2017 year of assessment ending 28th of February 2017. We had this asset for the full year. So in other words, our Section 12C allowance during the 2017 year of assessment is again 1,680 Rand. That means our tax value as at the beginning of the beginning of the tax year will then be 5,040 Rand. Okay, and then this asset, we again had it for the 2018 year of assessment, but we only held it until the 1st of July. But again, any manufacturing asset is deductible over any portion you own it during the year. So we're going to deduct the 20% capital allowance, 12C allowance of 1,680, bringing in our tax value as at the as at on the 1st of July 2017 as 3,360 Rand. Now this is the value of this asset after deducting the capital allowances when the flood was when this asset was damaged due to the flood. Okay, then what we did is on this we claimed an insurance claim and we got 8,000 Rand. So in other words, if we take our tax value less the insurance claim, that means we made a recoupment or we made a gain. And that's a recoupment according to section 84E. So in other words, we made a recoupment of 4,640 Rand. Okay. So this asset, this old asset, which got damaged, we replaced within a period of 12 months. So we actually replaced it within a 1 month period after the damage, and we replaced it with a new asset, and it was also brought into use within 3 years. So that's according to paragraph 66 of the 8th schedule. We may claim whether we made a capital gain or loss. Okay, so what we need to do is we need to calculate the so we may include this recoupment amount in our income under section 8(4)(EB). So we're going to take this 4,640 Rand recoupment and we're going to multiply it by 40%. That's according to paragraph 66 of the 8th schedule. So in other words, we may include 1,856 Rand within our income because we replaced it by a new machine within 12 months. We'll replace it by we replaced the plant within 12 months, and it was brought into use within 3 years after the sale of the original plant. Okay, and then just calculate capital gain or loss. This we'll also deal with at a later stage, but we've got our process which we made of 8,000 Rand less the recoupment. So that means that our process is then 3,360. What is our base cost? Our base cost is the original cost less all the capital allowances. So our base cost is then 3,360. So that means we neither made a capital gain or capital loss. So there's no capital tax on that. But this we'll deal with at a later stage. Okay, and then quickly looking at the new plant that we bought. So the cost, so we bought it into use during the 2018 year of assessment on the 30th of November 2017. It was brought into use on the 31st of January 2018. So the cost of it is 16,400. Because it's a new asset, we may allow 40% capital allowance according to section 12C. So in other words, our 12C allowance is then 6,560 Rand. So the tax value at the end of the 2018 year of assessment is then 9,840 Rand. Okay, so you can have a look at this summary here. But it just tells you the capital allowance during each of the years of assessment. So 2016-17 we just had the normal or the original plant which was used, so that's just on 20% of the cost, so it's 1,680 Rand allowance. And then again we had this asset during the 2018 year of assessments, again 1,680 Rand capital allowance, but we also purchased a new plant. So the capital allowances are 40% because there's a new asset. So the total section 12C capital allowance is then 8,240 Rand. And then we also made a section 84 EB recoupment, which we can include in our income of 1,856 Rand. Okay, so that's it for now on capital, on your capital allowances and recoupments. So please go through it, and please also go through a few questions in this textbook, in your graded questions on income tax in South Africa. It summarizes the work very well, and it is really something that you need to go through and work through in order to prepare for the test. Okay, so that's it.